Here's a sobering reality check. American consumers are feeling increasingly gloomy about the economy, and the numbers don't lie. The University of Michigan's Consumer Sentiment Index plummeted to 55.4 in September, falling short of the expected 58 and marking a significant drop from August's 58.2. But here's where it gets even more concerning. This isn't just a minor dip. It's a clear sign of deepening pessimism among households. And this is the part most people miss. When consumers lose confidence, it's not just a number. It's a warning signal for the broader economy. As spending tends to drive a whopping 70% of U.S. GDP. Digging deeper, the details are equally unsettling. The Consumer Current Conditions Index slipped to 61.2 from 61.7, while the Consumer Expectations Index took an even steeper dive, dropping to 51.8 from 55.9. Meanwhile, inflation expectations are sending mixed signals. The one-year consumer inflation expectation held steady at 4.8%, but the five-year outlook climbed to 3.9% from 3.5%. Is this a sign that long-term inflation fears are creeping back in? It's a question worth debating. The markets didn't take this news lightly. The U.S. dollar index, which had been declining earlier in the session, retreated after the report, ending the day with a modest 0.2% gain at 97.70. Speaking of the dollar, its performance this week has been a mixed bag. Against major currencies, the greenback struggled the most against the Australian dollar, shedding nearly 1%. Here's a snapshot of how it fared across the board. Currency pair, USD, EUR, GBP, NZ, CHF. Then, USD, negative 9.7%, negative 4.1%, negative 1.9%. EUR, negative 30%, negative 26%, negative 16%. 0.37%, 0.30%, negative 4%, 0.45%, negative 5%, 0.75%, 0.41%, negative 4.73%, 0.24%. AUD, 0.05%, 0.45%, 0.75%, 0.95%, 0.95%, 1.16%. NZD, 0.99%, 0.87%, 0.57%, 0.73%, negative 39%, 0.77%. CHF, 0.11%, negative 20%, 0.26%, negative 1.77%. Confused by the table? Here's a quick tip. The percentage change is calculated with the base currency on the left and the quote currency at the top. For instance, USD JPY at 0.07% means the dollar gained slightly against the yen. Looking ahead, the University of Michigan's preliminary Consumer Sentiment Index for September was initially expected to soften to 58.0 from August's 58.2. However, the actual reading of 55.4 underscores a sharper decline than anticipated. Why does this matter? Because consumer sentiment is a leading indicator of economic health. When households feel uncertain about their finances, they're less likely to spend, which can ripple through the entire economy. And here's the kicker. This data comes on the heels of a string of dismal employment reports. The U.S. Bureau of Labor Statistics recently revised job creation figures downward by a staggering 911,000 for the 12-month period through March 2025. Add to that a spike in initial jobless claims, and it's clear the labor market is on shaky ground. With inflation ticking up moderately in August, the stage seems set for the Federal Reserve to cut interest rates, possibly as early as September, with more cuts likely before year-end. But let's not bury the lead. September's consumer sentiment figures are likely to reinforce this narrative. If August's report painted a picture of growing pessimism, September's data suggests things have only worsened. The 15% year-over-year drop in sentiment highlights the toll of trade policies and economic uncertainty on American households. Is the Fed acting fast enough to counter these headwinds? That's a debate worth having. For the US dollar, this isn't exactly a vote of confidence. With concerns mounting that the Fed might be behind the curve on rate cuts, the greenback is feeling the pressure. Weak employment, tepid inflation, and sinking consumer confidence create the perfect storm for monetary easing. But will it be enough? Shifting gears to E-Euro-USD, the pair's rally has stalled below the late July highs of 1.1790, though it's found support above 1.1700. Geopolitical tensions in the Eurozone, particularly between Russia and Poland, are adding another layer of complexity. Will these frictions overshadow the dollar's weakness? Or is E-Euro-USD poised for a breakout? Only time will tell. Lastly, a quick refresher on the US dollar's role in the global economy. As the world's primary reserve currency, the dollar dominates foreign exchange markets, accounting for over 88% of all transactions. Its value is heavily influenced by Fed policy, with rate hikes typically boosting the dollar and cuts weighing it down. Quantitative easing, QE, and tightening, QT, also play a role, though these are tools reserved for extreme circumstances. But here's a thought. With the Fed's toolkit expanding, are traditional policies still enough to steer the economy? Share your thoughts in the comments. Let's spark a conversation.